Right now, investors turning their attention to the third quarter earnings season. PepsiCo reporting moments ago, earnings and revenue topped expectations. Other big names on deck this week, Yum Brands, Alcoa, among others. So will it be another quarter of declines for the S&P 500? Joining us right now with what to expect, S&P Capital IQ Senior Director Rich Peterson joining the conversation. Good morning, Rich.
Good morning, Maria.
Tell us what the third quarter reporting season looks like.
It's going to be very challenging.
Yeah.
As it always has been. Actually, we've been having an erosion in earnings growth. The last time we had double-digit earnings growth was in the second quarter of 2014. We've been steadily going lower.
Yeah.
Second quarter numbers were 0.1%. That's the bad news. Well, actually, the good news.
No growth. That was the good news.
No growth.
It was no growth.
But when we started earnings season for the second quarter, expectations were negative 4%. As we're seeing now, expectations for the third quarter numbers are negative 4.9% for the S&P 500, way down, as we're well aware, by energy. Energy expected to decline 66% year over year.
So it's largely energy taking the numbers down.
X-energy is like 3.1%. But then, saying, X-energy is like saying X-Republicans, the Democrats will control Congress.
Right. So yeah, no kidding. Energy is well. Look, we can talk about that all day. Why do we do the PPI and strip out energy and food? That I'm always scratching my head about. Okay, so earnings are going to be down almost 5% is the expectations for the third quarter. You guys are talking about buying stocks for long term. Why would I buy into a situation where there's no growth in corporate earnings?
Well, look, I think the challenge right now is obvious, as pointed out. But as we look forward, we think in the U.S. you're going to see probably the third quarter grow about 2%, but improving in the fourth quarter, and then growing at a better rate next year. Global growth, we still think, Maria, will be around 3.5%. So next year, we think earnings grow 5-6%, plus you get a dividend on top of that. So as we look at equities versus fixed income, we're still saying to our clients, we think equities represents a better value and a better return opportunity.
Jason.
I think you also have to look through some of these numbers. I mean, there's a big energy piece to that, that downdraft in earnings expectations, and there's other pieces of the whole corporate sector that actually look reasonably well, whether you're looking at staples, healthcare, maybe not industrials right now, but some of the pieces look reasonably well. So I think investors have to kind of step back and think about ownership of the businesses, and also think about where there are some bright spots in the corporate environment.
Yeah, where we're seeing improvement really is in consumer discretionary in terms of housing, restaurants, perhaps in healthcare, as we told all the M&A activity in healthcare, and telecom.
In the last couple of quarters, the strong dollar has hurt some of these multinationals, but the dollar recently has been turning over.
It has. Rich, look out. Is there still too much optimism out if you go in first quarter of next year? Like, because we know, because looking at the current quarter that's about to be announced, we know it's going to be negative. But what do you see in first quarter? Still wild expectations.
Yeah, that's a good observation, because you look back maybe 3 or 6 months ago, expectations for first quarter 2016 were all double digits. Now they come down to the mid-single digits. We're not going to see, analysts don't expect to see double-digit earnings growth for the S&P 500 until third quarter 2016.
Okay.
Well, I mean, how do we continue to see these great numbers as all of our trading partners are so challenged? I mean, everyone's talking about the global story, emerging markets still in a funk. Europe, we know where Europe is, struggling and trying to recover. And the U.S., you look at the jobs numbers and they're below expectations.
Well, I think one of the things that we kind of have to realize is that we are in a slow growth environment. The economies around the world are going through a fairly long, it's not really a recovery because we're in growth mode now, but it's a slower sort of expansion than we've seen before, because we're working off of excess debt that was put in place in the early 2000s. We're going through that process. Growth is slower. It's the reason rates are lower, but it doesn't mean that we can't have growth of some sort. And something in that single-digit range for earnings growth is a fairly reasonable expectation. Both the U.S., I'd probably also argue that Europe is getting back to an actual positive growth environment, and Japan is getting to a positive growth environment. So, 3 of the 4 big engines, pieces of the global economy, are actually looking like they're expanding at this point in time at an okay clip.
So you want to buy Europe and Japan?
We've been investors internationally for quite some time. The valuation argument there is much more compelling than the U.S. So for the investors that can handle and stomach the risk that comes with overseas investment, we think that's a better opportunity to some degree than the U.S., depending on, you have to kind of finesse the position. But you have to, it is more attractive and more interesting.
You know, it's interesting, Maria, to Jason's point, if you look at the individual economies out there, less than 9% of those economies are seeing negative growth. You know, emerging Asia is still 2 to 5. India 7, China decelerating, but still somewhere between 5 and 7. U.S. 2.5 to 3. So there's some better news out there, but during difficult times, we tend to over-engineer, over-focus on, and try to almost reverse-engineer. The market's down a lot, so where is the problem? And so you can tend to focus sometimes too much even on bad news. And I think that's part of what's going on here.
You told us what the expectations are for the third quarter, Rich, but what about guidance? What are you expecting these companies to talk about and say when it relates to the fourth quarter?
Well,
and as Dagen said,
well, again, management remains very cautious. Again, we're looking at Alcoa numbers coming out on Thursday. Materials is going to be the second worst performing sector. So I think the Alcoa numbers may be impacted by what's going on in the sector. And as we're well aware, Alcoa is doing corporate action to to sever the company into a low commodity business and a business that provides materials to the transportation industry. I think companies that are less reliant on energy, less reliant on emerging markets, more reliant on the consumer will do well going forward.
All right, I got to get your take on the Fed and whether or not we are just in this volatile period until we get clarity on that. So we'll come back to that. Rich Peterson, thank you very much. Rich Peterson there.